the traditional education system. While schools excel at preparing students for conventional employment, they often overlook critical financial literacy and wealth-building principles. This gap in education has been notably demonstrated by successful entrepreneurs like Steve Jobs and Bill Gates, who found their path to success outside the traditional academic framework by focusing on value creation and business development. This perspective is illustrated through Robert Kiyosaki's personal experience. Despite having a father who held a PhD and served as Hawaii's head of education, Kiyosaki's financial education came from a different mentor who taught him a fundamental principle. Financial independence stems not from academic achievements, but from understanding financial mechanisms and markets. The key message here is that achieving financial success often requires thinking beyond traditional employment. While conventional education prepares individuals for stable careers, building substantial wealth typically demands an entrepreneurial or investor mindset, a perspective that often needs to be developed outside traditional academic settings. This understanding forms the foundation of Kiyosaki's approach to wealth creation, which he has shared through his best-selling book, Rich Dad, Poor Dad, and his work as an investor, entrepreneur, and educator. Teachings focus on transforming how people think about money and wealth creation, moving beyond the traditional employee mindset to embrace entrepreneurial and investment opportunities. Number 1. Don't live below your means. Robert Kiyosaki presents a transformative perspective on financial success that challenges conventional wisdom about living frugally. Rather than restricting spending, he advocates for strategic wealth building through asset acquisition. His approach involves first creating income-generating assets that subsequently fund desired purchases, whether a Ferrari or a Rolls-Royce. This methodology stems from his financial education through the Rich Dad Company, which diverges significantly from traditional financial advice. Kiyosaki further illustrates this principle through his analysis of the cash flow quadrant. He categorizes financial positions into 4 segments: employees, E, and self-employed individuals, S, who directly exchange time for money, versus business owners, B, and investors, I, who leverage systems and capital for wealth creation. He advocates transitioning to the latter categories, noting that while traditional employment paths like teaching offer security, they rarely lead to substantial wealth accumulation. Work to learn, don't work for money. Kiyosaki shares his personal development journey, acknowledging his initial discomfort with sales, despite its crucial role in business success. He invested 4 years in developing his sales capabilities, viewing this period as an essential investment in his entrepreneurial future. This experience underlies his principle that career decisions should prioritize skill acquisition over immediate financial compensation. He advocates for embracing challenging positions that offer significant learning opportunities, even if they don't provide the highest initial compensation. This philosophy extends beyond just sales skills. Kiyosaki emphasizes that every professional experience, whether in management, marketing, or operations, contributes to building a comprehensive business acumen. He particularly values roles that expose individuals to multiple aspects of business operations, as this broad understanding becomes invaluable when building and managing enterprises. The focus on learning rather than earning enables individuals to develop the diverse skill set required for long-term financial success. Furthermore, he suggests that this approach helps develop resilience and problem-solving abilities, which are essential for entrepreneurial success. Number 3, the most important thing is cash flow. The cornerstone of Kiyosaki's financial philosophy revolves around understanding cash flow patterns. He defines assets and liabilities through a straightforward lens. Assets generate positive cash flow, while liabilities create expenses. This definition challenges common assumptions about wealth-building vehicles. For instance, he argues that residential property, often considered an asset, frequently functions as a liability due to ongoing expenses paid to financial institutions. Similarly, he cautions that traditional investment vehicles like stocks and mutual funds may primarily benefit financial institutions rather than individual investors. Kiyosaki emphasizes that successful wealth building requires a fundamental shift in how we evaluate investments and expenses. He advocates for focusing on investments that generate consistent, positive cash flow rather than speculating on potential appreciation. This approach provides greater financial stability and reduces dependency on market fluctuations. Additionally, he stresses the importance of understanding the timing of cash flows, as the sequence and reliability of income streams can significantly impact overall financial health and investment success. Number 4, The rich don't pay taxes. Through strategic business structures and investment vehicles, wealthy individuals can often defer or reduce their tax obligations significantly. The tax code provides numerous opportunities for those who generate income through business ownership and investments, such as depreciation allowances, capital gains treatment, and various deductions not available to traditional wage earners. Understanding these mechanisms requires sophisticated financial knowledge and often professional guidance, creating an additional barrier between those who can access these benefits and those who cannot. Moreover, the complexity of tax regulations means that those with sufficient resources can employ tax professionals to identify and utilize legitimate tax minimization strategies, while typical employees generally lack access to such comprehensive tax planning services. Number 5. Learn how to read a financial statement. A cornerstone of Kiyosaki's financial philosophy centers on developing comprehensive financial literacy, particularly the ability to interpret financial statements. This skill encompasses understanding the relationships between income, expenses, assets, and liabilities. Traditional educational systems often overlook this essential knowledge, yet it serves as a critical indicator of financial intelligence. Mastering financial statement analysis enables individuals to make informed decisions about wealth creation and management. Number 6. Cash flow quadrant. Kiyosaki's cash flow quadrant framework provides a structured approach to understanding different income generation methods. The model identifies 4 distinct categories: employees, E, and self-employed individuals, ESS, who exchange time for money, versus business owners, B, and investors, I, who create systems that generate wealth. Transitioning from the left quadrants, E and S, to the right quadrants, B and I, requires a fundamental transformation in both mindset and skill set. This shift focuses on developing systems and leveraging resources rather than directly trading time for income. Success in the right quadrants depends on understanding how to effectively utilize both financial and human capital to create sustainable wealth-generating mechanisms. Number 7. Leverage other people's money. Kiyosaki emphasizes that wealth creation often depends on effectively utilizing other people's resources, specifically their time, OPT, and money, OPM. This approach enables wealth builders to expand their operations beyond personal limitations. For instance, successful real estate investors employ mortgages and partnership structures to acquire properties, structuring deals so the assets themselves generate sufficient income to cover debt obligations while producing additional returns. To maximize the value of these wealth-building principles, consider implementing a systematic approach to financial education and wealth creation. Success in this arena requires ongoing learning, strategic thinking, and careful implementation of these concepts. The path to financial independence involves understanding and applying these principles while developing the necessary skills and mindset. The journey to financial success is continuous, requiring dedication to learning and implementation. These principles serve as foundational elements for building sustainable wealth and achieving financial independence. By understanding and applying these concepts systematically, individuals can work toward creating lasting financial success and establishing generational wealth. For those committed to this path, it's essential to continue expanding your financial education, developing relevant skills, and building the networks necessary for success. Remember that wealth creation is not just about accumulating assets, but about developing the knowledge and capabilities to manage and grow those assets effectively over time. Through consistent application of these principles and ongoing education, individuals can work toward achieving their financial goals and creating lasting prosperity. The key lies in taking decisive action while maintaining a long-term perspective on wealth creation and management.